Thanks for staying late. I know there's many other conferences you can be at, so we'll try to make it interesting. Unlike the previous panel, I think we will do a round of introductions just because not everyone may know what each one of us does. So I'm moderating, and maybe I'll just go first. My name is Alice Chen. I'm the co-founder and general counsel for InvestaX, and we are a licensed digital securities platform offering tokenization, primary issuance, and secondary trading venues. The reason I say venues is because we've also created a sister project modeled after Uniswap, where we provide an AMM for security tokens. I think it's one of the world's first. And so essentially anyone who holds a security token can create their own liquidity pool. From a background perspective, I'm a lawyer by training, and 7 years ago we started this company, IXSwap and InvestaX.
Perfect. Hello to all of you. My name's Steve Bowman. I'm based here in Singapore. I'm the managing director and head of APAC at BitGo. Quickly about BitGo, we're one of the longest running, most well-established custodians in the crypto space, having been at it since 2013. We basically do a few things. First, we offer programmable wallets. Second, we offer real, regulated, qualified custody. And lastly, we have a very robust prime brokerage product offering. In terms of who we target, we basically look at 4 verticals. The first is institutions, which tend to be banks, asset managers, people like that. Second, what we call platforms, which I guess most people would call technology companies or people that are technology adjacent. Third, coin foundations, and lastly, governments. And BitGo has been quite successful in this space. Matter of fact, about 20% of all BTC transactions by value happen on our pipes, and we've processed over $1.5 trillion worth of flow since inception. In terms of personal background before that, and I have to say this in a low voice, I used to work in TradFi. Previously, I was the head of macro sales at Nomura headquarters in Tokyo, and before that was a career banker across London, Sydney, Tokyo, New York, and San Francisco.
Thank you. Good afternoon. My name is Boon. I work in TradFi. I work in Deutsche Bank in the securities services business, responsible for fund services as well as technology advocacy. So in this space, we are focused on the intersection between DLT and crypto with capital markets use cases. Thank you.
Hello, everyone. My name is Anatoly. I run a firm called Nickel Digital. We are a London-based investment manager focusing on digital assets, offering access to crypto market for institutional investors. The philosophy behind the firm was to kind of address those points which were kind of points of concerns by institutional investors, specifically regulation. We got regulated both in the UK and the US, custody solutions, then building transparency around our operations, and ultimately building a team of people moving from traditional finance. And I will say it loudly, I used to work in traditional finance as well. And my prior experience was with JP Morgan and Goldman, and I left TradFi 4 years ago to build a crypto-dedicated fund. Thank you.
Hey, what's up, everyone? I'm Will Villanueva, so I'm the CEO and founder of Element Finance. We're in DeFi. Quick background, so me and my co-founder Johnny were involved in ETH2. He actually hired the team that did the spec for the merge, so congratulations to him. It was cool. We got into DeFi about a year and a half ago, built Element Finance. Essentially what we do is we take different yield positions in the space, something like staked ETH, validator positions, things like that, even MEV extraction bots. You can sort of think of a number of things. And we split it into 2 pieces, the principal and the interest. And we essentially have an AMM, an automated market maker around this that essentially allows you to trade the principal and also the variable side of a position that you're in over a fixed period of time. This creates fixed rate interest markets. It also creates really interesting, sometimes aggressive leveraging direct purchase to interest rates as well. And yeah, we're just a bunch of nerds that sort of built this and have been having a lot of fun. So I'm excited to be here. So yeah.
Okay, before I get started, I think just a bit about my experience starting in the space 5 years ago in the security token space. There was no event like this. I remember seeing Malcolm, we would go to these crypto blockchain conferences and there might be 1 or 2 panels on maybe security tokens and so to see that there's a dedicated 2-day conference on institutional adoption of security tokens and tokenization and DeFi use cases as well is progress and definitely advancement and development in the space. And I think, if you were here earlier when Nandu, actually the Chief FinTech Officer of the MAS, said, and I thought this tied in really well to our discussion because we have a really difficult topic. We're talking about DeFi for, financial institutions. And I think we'll get into this a little bit later. Is that an oxymoron, right? Is there conflict there? Because Sap also mentioned in his conversation with Raul that it's hard to believe that you can program all of the risk parameters into smart contracts today, at least, right? And you have to have that accountability somewhere. And they, as regulators, don't care to regulate the technology, but they care about accountability. So we're going to try to reconcile some of that on this panel. But I think to get started, I think we go back to the basics and for those that might not really know what DeFi is, we'll talk about DeFi, permission DeFi. Is it the asset? Is it the infrastructure? What is it? Maybe we start off with Boone. Because you come from, the institutional perspective.
Because you're still in TradFi.
So I'm still in TradFi, and therefore I'm allowed a more conservative definition of DeFi. We view DeFi as a couple of things. Firstly, right, is the infrastructure and software, the smart contracts, and very importantly, but which is we think is under focus, right, is tokenomics and how it actually regulates behavior in the DeFi space. Then, from a DeFi composability, let me take a different angle. Since I'm coming from a risk management as well as adoption, right, by financial institution or regulated space. So, we'll break down into trading strategy. So, staking, borrowing, lending, which is really an agency type of service, but which actually generates fixed income type of returns, regular returns. Then we'll separate that with, let's say, liquidity pools, AMMs, and bot tradings, right, which infers a much more active type of activity and management. Overlay with leverage and relative arbitrage and multiple relative arbitrage. From this angle, then we could see that there's all this really important component of DeFi, borrowing, staking, lending, AMMs, liquidity pools. But we can take a look at it from their payout structure characteristics in order to then better understand from a due diligence and adoption perspective. Where can we start? And then, what do we need to start looking at from a risk and adoption perspective? Permission DeFi very quickly. Today, we all know that in blockchain, we are not exactly totally anonymous. We are pseudo-anonymous. People can identify our wallets, right? So, for example, Nansen has identified the 7 wallets that participated in the Terra Luna thing. Therefore, a permission DeFi, which if we say that is on public chain with decentralized identity with KYC ML and potentially with a level of confidentiality, is not necessarily too far of a stretch. And in fact, it could actually encourage adoption as well. I'll stop here. Thank you.
That was actually a surprising response. I thought you were going to take a different angle on that, but maybe just going to the, I think, truly DeFi native project on the panel here. Will, what's your perspective, and can you separate the asset from the infrastructure? And if you can't, does that impose an issue to institutional adoption?
Yeah, actually, I think it makes a lot of sense. That's why I'm here. So you can sort of see a lot of these underlying protocols as sort of testing grounds. Right now we're sort of innovating on. We're seeing how does this work in these micro sort of market formats. But as far as then building permission systems around this, you can take it, you can wrap it, you can actually make it so there is a KYC process to even onboard into the same infrastructure that can then also interact with the full DeFi system. But there's one particular thing that I'm really interested in. So there's a way to sort of do, for example, you can use a technology called zero knowledge proofs, where I can prove, for example, that this person has gone through KYC. This person has not violated these particular laws without actually identifying the characteristics of this person as well. And this is also cool because you can also maintain a level of privacy that's still permission, that can still work within the boundaries of regulation and things like that. And so these are a lot of the things that I think about.
And just to add to that, right? So with zero knowledge proof, then perhaps there could be a view key that's available then in case regulators would like to take a look who is actually hiding behind the ZK proof. And then with a view key, you could actually take a look at it. Same concept like Zcash.
Yeah, you could do that. You could even do it in even a decentralized way too, right? Or like where regulators are multi-sig that has an ability to do that as well, which is super, super interesting. Yeah.
Just for my own knowledge, can you just elaborate a bit more on how the zero knowledge proof would work? I think maybe for the audience as well. But for regulated entities, if you were to be able to actually implement that, you're actually now saying to SOP, Nandu, the fintech officer, it can be done, right? You're actually, but then ultimately it still comes down to accountability. And so it's not just about the KYC and that aspect, but also accountability. Somebody as a counterparty needs to be held responsible. But yeah, if you could just share.
Yeah, correct. So if you have certain rules or constraints, right? Like let's say you can't, bring this much amount of funds in. You can't exit amount, this amount. You are, a KYC'd entity. You're not splitting it amongst different wallets. There's a way essentially with this technology where you can show that you belong to a specific set without that follows all this. It's basically a mathematical construct without identifying which set member you are, as an example. And this is sort of plays into some of these interesting pieces.
There's a beautiful underlying math under zero knowledge proof. And the logic is I can prove to you that I have certain credentials without revealing full information. How the system verifies that? There is a set of requests which are floating between you as an inquirer and me as a party who confirms my identity or any information. And this math establishes the outcome, but there is no information kind of revealed to the public or to the network. And that's the beauty. It's a zero knowledge proof with the ultimate confirmation.
And for the accountability part, right, this actually could be issued by a trusted trust anchor, a trusted licensed entity. So already in that sense, right, you have got the accountability. Of course, then the other part of the accountability is who's going to be accountable for the DeFi strategies and assets.
I believe the trust anchor portion is one of the projects, one of the pillars that Project Guardian is meant to explore. So perhaps Deutsche Bank will be involved in that.
Perhaps.
Perhaps, okay. So, Will, I think we'll come back to you because we need to speak to Stephen as well. I think we had a side chat just in terms of, the oxymoron of can you really offer DeFi to financial institutions? And is that really a conflict in itself?
I don't think that DeFi and institutions are an oxymoron for two reasons. The first is just a simple semantic one. Institutions is a pretty catch-all phrase. DeFi is a pretty catch-all phrase, and there's all sorts of permutations within each of those phrases. There's a big difference between JP Morgan and a fund that has $50 million. Likewise, there's a big difference between all the different DeFi products out there. But the second reason why I don't think it's an oxymoron is probably the one that's a little less understood. Believe it or not, I don't believe that Jamie Dimon at JP Morgan or Larry Fink at BlackRock wakes up in the morning and goes in a Gollum voice, "How can I centralize it all for me, my precious?" I don't think that happens. What I think does happen is they get out of bed and say, how can I come up with exciting new products that will improve our profit margin, keep my board happy, and do it in a scalable, safe manner? Okay, exciting new product. You can make money from it, scalable and safe. That sounds a lot like every mission statement of most DeFi projects. So no, I don't think it's an oxymoron.
Yeah, and so yesterday, I think it was Six Digital Exchange said that they were trying to disintermediate themselves by creating a digital platform, right? So is it the case that a lot of these institutions are seeing the trend and kind of foreseeing that they'll either wait and get disintermediated, or they try to explore, these use cases on their own? Happy to hear thoughts from maybe Boone. Any thoughts around that?
Can I come back? I was daydreaming.
No problem. Anyone?
Do you mind if I just? I want to add one thing onto the definition of DeFi real quick, and just to, I know it's slightly divergent from that. As I sort of see it also as it's open sourcing like finance and open sourcing the data, the algorithms, the access to it, right? Which is really cool. And so I sort of see it as this is why there's been a lot of innovation that's been happening there. It's similar to when cell phones were sort of closed source. Then all of a sudden you had the App Store. You suddenly had the open sourcing of applications on your phone. You had all this innovation. People are creating all these different types of applications that are there. And this is what I see DeFi as essentially. It's the open sourcing of this software. It lets more people innovate and play into it. And so I just wanted to add that because I think that adds more context when we think about, is it at conflict with institutions? Not at all. It's actually better. It's more innovation. So yeah.
And just to add to that as well, right? It's also accessibility and liquidity. So in DeFi, you need a depth of liquidity and assets. So if it becomes like, for example, in a closed wall or closed garden, then no matter how good the algorithms are, right? You won't have the liquidity to facilitate the financial activities.
Yeah, and I think just to come back to your point, Will. It sounds like it's really just an alternative to what you have seen in traditional financial services, but blockchain based, and there are other ways of earning fees. So you're maybe replacing existing products or services with new products and services that are supported by smart contracts, blockchain, in a different form. That's what I'm gathering.
Yeah, I mean, ultimately, when people view institutions, they're in the business of trying to improve their business, improve their bottom line, grow as a company, all these things that are, right out there in the open. And I think that sometimes it's been misinterpreted that if you go into DeFi, that's at odds with that ultimate mission. If they're looking at an opportunity to potentially grow their business and that opportunity just happens to be in liquidity pools, they're going to do it. If it happens to be in staking, they're going to do it. It's another part of the product toolkit. However, one thing I do want to caveat is when institutions look at these opportunities, they look at it through a couple of different lenses that may not be easily understood. The first of which is, how attractive on its own is the actual opportunity? And it's not just the headline rate that you might earn, it's how is it on a risk-adjusted basis? Because obviously they have a variety of other things that they could be dedicating the resources towards. And I think that, as a result, as institutions expand into DeFi, people shouldn't be alarmed that they're looking at these things. It's part and parcel of their natural business operations.
Okay, so then I think we have to talk about, the elephant in the room. What happens when you have cases like Terra Luna, Celsius, and Three Arrows, massive failures? And clearly, there were some problems there, right? Does that impact, I think, the institutional adoption of DeFi use cases? Obviously, the answer would be yes. But were there any positives that might have come out of this? Perhaps, creating better standards, more transparency. Any thoughts on that? And then I think I'll come to you, Anatoly, on as a hedge fund operator, how has that changed the way that you operate your business from a crypto hedge fund perspective?
Sure. I think risk management is the first thing which comes to mind. And certainly the standards will be tightened because what we saw in all this debacle, that a number of market players, even calling themselves a hedge fund, forgot to hedge themselves, right? And certainly it did not go unnoticed. The impact on the market is pretty severe because we actually faced a Lehman type of event when failure of one large entity caused this, the contagion effect across the whole industry, right? And as a side effect, wiped out the whole range of retail investors who had certain leverage in their accounts. And of course, it was extremely detrimental to the entire industry. Now, the new approach by allocators, and we've seen this in our multiple conversations, is really the first reaction is pause and see who's gonna survive. Second point is what is your underlying risk management techniques? And it's as critical as ever. And I think the biggest outcome of this will be a far more stringent requirements for operational setup and risk management run by investment firms in crypto.
Okay, I'll go next and after you.
Yeah, go for it. I'll say after you.
Okay, I just want to echo as well on that, from risk management, it actually says, I think, 3 points. Firstly, right, it has shown what's the upper boundary of, smart contracts and the DeFi space. Like, for example, Luna Terra, right, the two-coin model. And then after that, the mechanism, the tokenomics. So it worked. When it worked really well. But, this crisis shows, right, the upper boundary of where, right, the marginal utility starts falling down. So I think that's really important. So when we talk about risk management, then we talk about what risk to actually be looking out for. Secondly, as well, they also highlighted some of the practices that maybe can be better improved. Like, for example, in the DeFi space, there has been liquidity bootstrapping, and then it actually basically becomes a zero-sum game in taking a liquidity from one pool into another pool in order to seed my own pool. And in the end, right, it doesn't really necessarily create a bigger pie. But what's more important is that at this point in time, it sets up a very good opportunity for the industry, TradeFi and DeFi and the crypto space, right, to come and raise awareness and then to pierce through, right, all this high-level thing to go into details. Why is it important? Because, right, of the recency effect, plus, right, that regulators all over the world right now is actually arming themselves and coming up with momentum, right, on regulating what's CeFi, what's DeFi, what's all these things. So from IOSCO on settlement platforms to Basel to Financial Stability Board on systemic risk. So, if there isn't greater clarity on what actually happened, like, for example, in Three Arrows, or, to your point, right, it's like another Lehman or another LTMC, whereby a Black Swan event actually basically identified the vulnerability of a leverage trade, then at least we can put that into context for better understanding so that it can then hopefully guide rulemaking. Sorry. Yeah.
No, that was awesome, actually. And so a couple additional perspectives that I have is like, it both like proves DeFi and disproved it all like at the same time. So What do I mean by that? So this all was sort of triggered by DeFi, which is Terra Luna. That being said, like Element Finance, we never touched Terra Luna. We did like a lot of diligence on economic analysis. We were a little bit worried about that ecosystem, sort of, how it worked. And so that did show from, that aspect, we do need to have more stringent standards, auditing standards, not just on bugs and security, but also on does it work economically. So the other thing, the reason why it proves DeFi though, is if you brought more of these CeFi institutions on chain. So if you saw what Celsius is holding, if you saw what 3 Arrows Capital was holding, then it's open, it's transparent. You see where they're putting the capital, you see where they're transferring it, you see they're opening up this leveraged position, right? And now you know that, like, okay, my money's with 3 Arrows Capital, and they're doing all these weird things out in the open. I have notifications to it that they're playing with my funds in this certain way. And so that's why I actually think it actually verifies DeFi as well. So it's sort of like kind of took this like both catch-22 where it reinforces the idea of it, but also showed the risks and dangers of it all in one. So yeah.
Steve, any thoughts on that? Because I find it, going back to the point about being an oxymoron, DeFi for financial institutions. I also find that the way that these DeFi platforms worked, where the premise was based on decentralization, transparency, but then they worked in a black box type of model, was a conflict, right? Where you had a centralized entity kind of operating in a non-transparent way. Do you have any additional thoughts around that?
Well, I mean, going back to the original point about the regulatory bit around it, I think ultimately what we're going to need to see for all of this to kind of push forward is we're going to need to have improvement around 3 key areas. First is the obvious, the elephant in the room, regulatory stuff. What does that look like? It's not just about licenses, but it's also tax, KYC, AML, all of that. Second point is making sure that DeFi stays attractive, because ultimately capital will go wherever capital is gets the most bang for its buck. And not only is it, again, the risk-adjusted return, but it's also what's the size of the market. If you have $1 billion worth of capital to deploy, but the market can only bear $1 million, that's not really going to work for you. And then the last one is we need to mitigate headline risk. Find a way to basically get rid of bad actors, keep people from blowing up, force people to, well, not force, I never want to use that word, encourage people to have protocols in place where they're going to manage their functions in an above board manner. Because ultimately, if you look around DeFi and specifically the intersection with institutions, we don't have a lack of imagination. We don't have a lack of use cases. What we have is a crisis of credibility, especially in the eyes of institutions, their investors, and their board of directors. And the best way to bridge it is by doing the 3 things I just said.
And so what have you seen in terms of the uptake? You're a custodian and prime broker, and you'd also do lending and staking, right? What have you seen in terms of the uptake from your institutional clients of DeFi use cases?
I'm thrilled you asked this question.
Oh.
This will be an unabashed plug for the greatness of BitGo. We've been very fortunate. We've seen a robust uptick in our business with institutions in these verticals that you just described. To be fair, it's for 3 reasons, one of which is just a rising tide lifting all boats. The horse is out of the barn with respect to DeFi and the opportunities that lie within it. And we just happen to be in a company that can offer products to help you access that. So that was just across the board. But the 2 things that are relatively exclusive to BitGo are, the first is we just make it a very enjoyable, safe experience. We have a good UI, and you can stake your assets, for instance, from the security of our regulated qualified custody. And then the last thing is, institutions, we have found, when they want to face off with a partner, like anyone in life, you tend to look for people that understand your way of thinking and tick a lot of the boxes that you value. We are a firm that's regulated, we're licensed, we've been around for almost a decade. We've always been viewed within the industry as, for lack of a better term, the stable pair of hands. And I think that really resonates with institutions, because we both like transparency. We prefer to do our business in the light of day, not in the shadows. So it's really helped our story when pitching to them.
I would like to add to the DeFi CeFi conundrum. As a matter of fact, I think the whole debacle we saw in crypto reinforced the case of DeFi. Whilst there was a screaming in the press that the whole crypto collapsed and DeFi didn't work, the answer is everything worked exactly as expected, right? If you look on the lending and borrowing pools, decentralized models actually handled the whole kind of transition through higher to lower prices perfectly fine with no defaults, right? Celsius rushed to repay their DeFi borrowing because they needed to release underlying collateral. By returning $100, they would get back 130. So there was clear incentive. However, in the centralized systems, and Celsius being one of the centralized agents, right? When there is a human discretion on lending to other parties, that's where the failures emerges, right? And because they underwrite uncollateralized loans, Free AC was one of these counterparties, that led to failure. So from that perspective, DeFi worked perfectly fine. And even Luna Terra, again, it unfolded as expected. Many market participants, well before collapse in May, had a clear view that this, the way it's designed, the protocol, there is a flaw in the design, right? And it's gonna lead at some stage to hyperinflation. It was perfectly predictable. So there was no surprise. Market has taken this as a surprise because unfortunately, many market participants just do not do due diligence, right? And have very low risk kind of sensitivity. But I think after that, we're gonna have a much stricter internal due diligence on both institutional and retail side.
They only saw the 19% APR.
Exactly. So look at the headline. Forget about what is underneath.
But I think we all agree on this panel, and Will, I think you made a really good point, which is it proved that these massive failures with 3 Arrows and Celsius proved that it worked and didn't work at the same time. So it's really about what additional improvements can be added to a system that's working, right? I'm just conscious of time, and I do have more questions, but I'm wondering if I should take some questions from the audience, if there are any. And if there are any questions? No. Okay, so I was gonna end with a final question, and everyone does this. If you had a crystal ball, what do you think the financial institutions are most likely to adopt as a DeFi use case? And how long will that take? Maybe we can just go.
Yeah, sure. In no particular order, particular order. Staking, liquidity pools, tokenization, KYC, and because it's always sunny in my world, I'm going to be optimistic. Less than 3 years.
Less than 3 years, okay.
Funds that offers investors exposure into DeFi type of returns, but these funds in turn, right, are fractionalized, tokenized, so that a person with $100 could actually buy into a fund that offers, right, a portfolio of exposure. So I'll say that a very attractive use case for the financial institutions will be in the asset management space.
And how long?
It depends on the regulations and whether regulations allow two things, right? Will allow such a construct to happen. So perhaps, right, this is something to discuss with the regulator. So as long as the regulator would need to say yes.
That could be a long time.
So far we saw evolution of two parallel networks, permissionless and permissioned. Permissioned is driven by the institutions primarily, right, for a couple of reasons. Certainly there is potentially greater throughput, lower cost, but fundamental point of concern is KYC IML, right? That's something institutions cannot compromise, and hence their desire to create, perhaps desire to create these closed loops of entities who are pre-cleared and within which they can trade. Now, from my point of view, this is a temporary solution because ultimately they're going to be merged with permissionless network, whilst this certain group of people who are applying certain standards like KYC IML will operate on the permissionless network, but they would be able to interact within this kind of base layer, right? Sitting on top of it, rather than running a standalone separate network. So I would expect this merge between permissioned and permissionless to take place in the next 3 years. But ultimately, it will be far more robust systems without compromise of something which matters for institutional investors.
Yeah, I would actually agree. So I think more permission regulated systems that includes money market curves, innovation around that. I think in general, we fixed rate systems, variable rate systems. I think in general, just the innovation is going to move into this world over the next 5 years. It makes more sense keeping things in the open. It garners more innovation, which actually creates more profit. So even from a business standpoint, I think it's quite apparent. So yeah.
Actually, I have this is a very optimistic panel because I used to sit on panels and they say, oh yeah, the adoption rate may be 5 to 10 years, and now it's really come down 3 to 5 years. I love that. That's all the time we have. Thank you for joining, and welcome.
Thank you very much.